Money shapes our daily lives, from buying essentials to powering entire economies. But who actually decides how much money exists, and who pays for it? While many think governments simply print cash, the reality is far more complex. Money creation involves central banks, commercial banks, and government policies working together to maintain economic stability. And surprisingly, most money isn't even printed, it exists digitally. Understanding this system reveals how control, trust, and balance keep modern economies running. Money creation is not just printing paper. When people think of money creation, they usually imagine printing presses producing stacks of fresh banknotes. While physical currency does exist, it represents only a small portion of the total money supply. In modern economies, most money is created digitally. In the United States, for example, physical currency is produced by the Bureau of Engraving and Printing under the U.S. Treasury. The Federal Reserve, America's central bank, decides how much currency should be added to the economy. But it does not physically print money itself. Instead, it places orders with the Treasury, which manufactures the bills. This separation exists for an important reason. Controlling the money supply requires careful economic management, not just mechanical production. Central banks must balance economic growth, employment, inflation, and financial stability before increasing or reducing the amount of money circulating in an economy. Too much money can cause prices to surge. Too little can slow economic activity. Maintaining this balance is one of the most powerful responsibilities in modern finance. Why central banks control the money supply? Money is more than a medium of exchange. It is a tool used to manage economic stability. Central banks, such as the Federal Reserve in the United States or the European Central Bank in the Eurozone, monitor indicators like inflation, unemployment, interest rates, and economic growth. Based on these signals, they decide whether more money should enter the system or whether conditions require tightening. Their goal is simple but difficult: maintain price stability and support economic growth. If central banks allow too much money to circulate, inflation increases and purchasing power declines. If they restrict money excessively, businesses struggle to expand, unemployment rises, and economic activity slows. Because of this, money creation is never random. It follows carefully designed policies intended to stabilize the economy. How most new money is actually created. Here's where the process becomes surprising. Most money enters the economy not through printing presses, but through the banking system. Central banks primarily influence the money supply using a method called monetary policy, particularly through open market operations. This involves buying government bonds from commercial banks. In exchange, banks receive new reserves, which allow them to issue more loans. And when banks make loans, they effectively create new money. This may sound strange, but it is a fundamental feature of modern banking. When someone takes out a loan, the bank does not simply transfer existing money from another customer. Instead, it creates a new deposit in the borrower's account. That newly created deposit becomes part of the total money supply. This system, often referred to as fractional reserve banking, means that most money exists as digital entries in bank accounts rather than physical cash. In fact, physical currency represents only a small percentage of total money circulating in advanced economies. The real cost of printing cash. Although digital money dominates modern finance, physical currency still plays an important role. Producing banknotes and coins costs governments real money. In the United States, printing a single paper bill typically costs between a few cents and around 14 cents depending on its denomination. Yet once produced, that bill holds its full face value in the economy. For example, if a $100 bill costs about 14 cents to produce, it still functions as $100 once issued. This difference between production cost and face value is called seigniorage. It represents revenue for the government and can help reduce public expenses. However, not all currency generates profit. Coins, particularly low-value ones, often cost more to produce than they are worth. In the US, producing a penny has historically cost more than its 1-cent value, and nickels have also exceeded their face value in production costs. Despite this, such coins remain in circulation due to public preference, pricing convenience, and political considerations. What happens when too much money is created? While creating money can support economic growth, excessive money creation can lead to serious consequences. If the supply of money expands much faster than the production of goods and services, prices rise rapidly. In extreme cases, this results in hyperinflation, where currency loses value at an astonishing rate. History offers dramatic examples. Zimbabwe experienced one of the worst hyperinflation episodes in modern times during the late 2000s. Prices rose so rapidly that people needed enormous amounts of cash just to buy basic necessities. Similarly, Venezuela has faced severe inflation in recent years, where currency values collapsed and daily transactions became increasingly difficult. These cases demonstrate a critical lesson. Printing money does not automatically create wealth. Without real economic growth to support it, excessive money creation can destabilize entire economies. Countries that don't control their own currency. Another surprising reality is that some countries do not fully control their own money supply. Certain economies rely heavily on foreign currencies, particularly the US dollar. Some nations even adopt another country's currency entirely, a process known as dollarization. Ecuador and Panama, for example, use the US dollar as their official currency. While this approach can provide stability and reduce inflation risks, it also means these countries surrender control over monetary policy. Decisions made by the US Federal Reserve can directly influence their economies, even though they have no authority over those decisions. This highlights how global finance connects national economies in complex and sometimes unequal ways. The digital future of money. The nature of money itself is evolving. Central banks worldwide are exploring central bank digital currencies, digital versions of national currencies issued directly by governments. These could potentially allow individuals to hold accounts directly with central banks rather than relying solely on commercial banks. If implemented widely, such systems could reshape the financial landscape. Commercial banks might lose some of their traditional role in creating money through lending, while governments could gain greater control over monetary flows. At the same time, decentralized cryptocurrencies like Bitcoin present a different challenge. Unlike traditional currencies, they operate independently of government control and rely on distributed digital networks. Whether these technologies will transform global finance or coexist alongside traditional systems remains an open question. Money as a tool of power and trust. A banknote may appear to be just a piece of paper, but it represents a complex system of economic management and public trust. The value of money does not come from its physical form, but from confidence in the institutions that issue it. Governments, central banks, and financial systems must maintain credibility for currency to function effectively. Money creation therefore reflects more than economics. It reflects governance, policy decisions, and public belief in stability. The hidden balance behind every currency. So who really decides how much money exists? The answer involves a network of institutions, central banks controlling monetary policy, government agencies producing physical currency, commercial banks expanding credit, and economic forces shaping demand. Together, they manage a system that must constantly balance growth, inflation, and stability. The real cost of money is not the paper or metal used to produce it. It is the challenge of maintaining equilibrium within a dynamic and often fragile global economy. If money controls the world, understanding it gives you power. And now you know what really happens behind every dollar you spend. If you enjoyed uncovering the hidden systems shaping our economy, make sure to like and subscribe. Stay curious, stay informed, and we'll see you in the next video.